Hello and welcome to Nutmeg's Investor Update for December. I'm Casey Lord and I'm Head of Product here at Nutmeg, and I work on the digital side of our business. So it's partly my job to make sure that we meet customers' needs through things like our website and our mobile apps. And I'm joined today by James McManus, our Director of Investment Management and ETF Research. Hi, James.
Hi, Casey.
So on a global basis, it seemed that the investment markets had a pretty good time back in November. What caused this?
So that's right. So November was a really strong month for riskier assets such as equities and high-yielding corporate bonds. The sort of assets that we expect to perform well when market sentiment improves. So whilst the news continued to ebb and flow on the UK election, the US and China trade war, and less market-centric issues such as the US impeachment proceedings, what we saw in November was a real rise in investor sentiment in markets. And when we trace that back, really at the end of October, there were two key events that investors were focused on. The first was the Federal Reserve and whether they would cut interest rates for the third time since the financial crisis and stimulate the US economy further. And the second was whether the EU would grant the UK a further extension to Brexit and avoid that sort of cliff edge Brexit moment at the end of October. Now, both of those events were expected by market participants, but by no means were either a certainty. But as we moved into November with both of those behind us, both delivered as expected. Really, it gave room for a more positive sentiment in markets and investors to be more optimistic about the outlook.
Okay, so with that context, what was the impact then on the financial markets?
Well, global equity markets performed strongly in the month of November, delivering around 2.8% performance for the month. That was led by the US, and the S&P 500 delivered around 3.6%. That's a very strong month for the S&P. And then the tech-heavy NASDAQ delivering returns in excess of 4%. So again, a very strong month for returns. Close to home in Europe, equity markets delivered around 2.6%, in Japan 1.9%, and then emerging markets lagging their developed market counterparts with returns, but still in positive territory, returns of around 0.6%. On the fixed income side, what we saw unsurprisingly in a month where riskier assets performed well, corporate bonds held up. They delivered positive returns of around 4% for US investment grade. US high yield counterparts, their US high yield counterparts also delivering very similar returns. And again, as expected in a month where we saw positive performance in equity assets, in risk assets, government bonds, typically a safe haven, saw losses of around 0.5 to 0.8%.
Okay, so overall, a really positive picture then. But what about here in the UK?
Well, in the UK, we're really in a bit of a holding pattern as we await the outcome of the election. And the polls haven't materially shifted since the campaign began. We saw some movement, some gains for the Conservatives and for Labour at the expense of the Brexit Party and the Lib Dems so far. But investors are really focused on two things, and that is, one, whether the polls can be trusted. We've got an increasingly unpredictable electorate that is obsessed with quite a polarising topic in Brexit. And then secondly, whether the Conservatives can translate that poll lead into a solid seats majority and enable them to govern and potentially have a resolution to this ongoing Brexit saga. Against that backdrop, we've seen the pound steadily gain against the euro in the month of November. It rallied around 1.3% throughout the month. We've also seen UK equity markets join their global counterparts in a risk rally on the back of that more positive sentiment. The FTSE 250, UK medium-sized companies had one of its best months, in fact its best month since April, up over 4%. The FTSE 100 delivered returns of around 1.8%, so solid returns in equity markets. UK corporate bonds, similar to the US, were flat on the month. Up marginally, and UK government bonds, again, very similar to the US. We saw losses around 0.8% there.
Thank you. So how have the Nutmeg fully managed portfolios performed?
So given the strong performance of equity markets, as you might expect, all portfolios finished the month of November in positive territory, and we saw returns for our fully managed portfolios ranging from around 0.4%, the lowest end of the risk spectrum, all the way up to around 2.9% at the higher risk end of the risk spectrum.
So with this in mind, have you made any changes to the fully managed portfolios?
So we have made some minor adjustments to manage the balance of risk and reward in the portfolios, and that's included reducing the duration or the interest rate sensitivity of our US government bond holdings, and also adding to holdings of UK medium-sized companies just to reflect the balance of the risk for the UK election. So no significant shift in portfolio strategy, but really some rebalancing around the fringes of the portfolio to make sure that it's still aligned with our view.
Okay, thank you. So this month's customer question is from George, who asks about the so-called Santa Claus rally. This is where stock markets are often seen to rise in the run-up to Christmas. Will we have a Santa Claus rally this year?
Well, December often holds a lot of promise for investors, but as 2018 showed, there are no guarantees that we'll see a year-end rally. The term Santa Rally really in its strictest sense is referring to the last 5 days of December and the first 2 days of January. But it's also used by market participants more broadly to describe the sort of seasonality that we see in performance, particularly in the US stock market in December. And that is that historically December has been quite a good month for returns within any given calendar year. And in fact, before 2018, before last year, since 1950, December had never been the worst performing month in any given calendar year. That won't have been any comfort to investors last year, with the S&P down nearly 9% in absolute terms in December itself. So far, we've had a really strong year in US equity markets in particular. In fact, if we closed the year today, it would be the 15th best performing year since 1950 for the US S&P 500 equity market. So it has been a very strong year for returns already. That's not to say there can't be further returns towards the end of the year, and we remain overweight US equities. It's one of our preferred markets at Nutmeg. And we think actually in particular if we see any progress on trade, particularly US and China trade towards that initial phase one trade deal before the year end, then we'll see some further returns in equities. But as last year shows, there can't be any guarantees of a Santa rally, unfortunately.
Thank you, James.
Thanks, Casey.
And thank you for joining us. As always, if you have any questions, don't hesitate to get in touch with us via email, social, or the comments section below. And we look forward to seeing you again next month.